Reading good books on the topics of business and personal finance is probably one of the best resources that aspiring investors have to build and grow their knowledge. The problem is, committing to and reading a book takes a lot of time, and there are tons of books out there, and unfortunately, not all of them are great. Some even contain information and suggestions that could set you down the wrong path. Hi, my name is Paul, and I've decided to make this video to give you my personal recommendations on the books that I've read throughout the year, in the hopes that I'll be able to help expedite your progression as an investor and to help you expand on your knowledge. So, in this one, I'll be going through and critically reviewing each one of these books and letting you know which ones are worth the read and which ones you can safely skip out on. Now, I only read about 8 books this year, but my New Year's resolution is to set aside more time for reading, and I have a goal of at least doubling that number for next year, so hopefully next year I'll have a lot more books to recommend to you. Before I get started, I do have to mention that one of the books that I read left me with nothing positive to say about it, so much so that I felt a sense of guilt at the idea of even giving away my copy. The thought of someone else reading it and following the misguided strategies outlined would almost certainly lead the reader to financial ruin. That said, I don't want to name the title or author of this book, since I don't think it's necessary to point fingers and make negative comments directed at the individual involved. It's the bad ideas here that are the problem, and those ideas are a big enough target for criticism on their own. Plus, unlike people, ideas don't have feelings that get hurt when they're called out for glaring stupidity. On that note, I strongly recommend that you think critically while reading, and even more so when presented with a multi-point system or strategy that contains contradictions, requires excellent timing and precision, or is just incredibly difficult to follow. In addition to having all of those, this particular book had a large section dedicated to following and understanding charted price patterns. This segment contained a series of examples, which, one after another, would include amendments pointing out how the previous example might be, to put it into my own words, a fake-out. On top of that, there was no solution offered to figure out ahead of time whether or not the pattern being observed is a deceptive one. The fact that, despite these self-evident pitfalls, chart analysis was still considered worth including as part of the overall system should speak loudly to the quality of the rest of the information presented in the book. Thankfully, I picked up my copy at the local Goodwill on half-off day, and I probably should have clued in that it wasn't going to be a good one after coming across 3 other copies while browsing for other books. In the end, it only cost me $1 or so, and it ended up in the recycle bin to hopefully get a second chance at becoming something of value. Luckily, the other books that I will not be recommending do have at least some quality information, even if I do have some major gripes with them. For instance, my first non-recommendation is Winning the Money Game by Adam Carroll and Chad Carden. This book was one that, believe it or not, I picked up at a library book sale for 25 cents, so they were practically giving it away, and it had a title that looked promising, so I figured why not give it a once-over and see if there were any hidden gems inside. Unfortunately, it turned out to be a very beginner-oriented book, focused on teaching how to reduce expenses, pay down debt, and build basic but good financial habits. Now, Winning the Money Game did have a personalized touch that highlighted the stories of the 2 authors and their paths to achieving financial security. This made the book a bit more relatable and would probably be helpful in teaching how to implement the principles of personal finance being showcased. Plus, it helped that the book was a short and easy read with very large font. That said, there probably aren't many people in need of building those skills who would be watching a channel like mine. Plus, virtually everything in this book is fairly commonplace knowledge, most of which can be found elsewhere. So, while the book would be beneficial to anyone interested in learning to build some simple budgeting and saving skills, neither you nor I are likely the target demographic for Winning the Money Game. So, I'll be donating my copy, and I would recommend that you skip it. The next book is Burton Malkiel's A Random Walk Down Wall Street. Overall, I'd say that this book has segments that were both interesting and informative, especially throughout Part 1 and Part 2, and even some of the portions in Parts 3 and 4. The summaries of historic market crashes, the explanation of different investment theories and their shortcomings, as well as the in-depth commentary on fundamental principles of investing and the different types of investments are all covered quite nicely. However, A Random Walk Down Wall Street does unfortunately contain a few drawn-out segments, specifically in Part 3, which covers in detail some of the more modern investment strategies, like the utilization of beta as a measure of risk and why it can be a useful metric for doing so. To be fair to Malkiel, some of the main drawbacks of using beta are acknowledged in the book, but the book seemed to resign itself to the idea that risk and volatility are at least partially the same, which, if it weren't already obvious, is something that I wholeheartedly disagree with. The idea that you can figure out how risky a stock is based on its past price movements relative to the market is wholly irreconcilable with the reality that human sentiment, which can at times become exuberantly irrational, is the main driver of stock prices. But this isn't a video about my dislike of the beta metric, so you'll just have to wait a little while for an in-depth video on that topic. Anyway, my other issues with the book mostly have to do with the promotion of inferior theories of investing, like the adherence to modern portfolio theory, high levels of diversification, and the recommendation to adjust your portfolio away from stocks and towards bonds depending on how old you are. Noting that, I did read the 1999 version of the book, so some of the content that I read may have been changed in newer editions, and because I haven't read those newer publications, my criticism is only directed towards what I read in the 99 version. Still, the one that I read did provide a reasonable framework and promoted the virtues of index investing, which is very unlikely to lead to financial harm. So I do think that the book does have some worthwhile content in it, but I don't think that someone looking to passively invest in index funds should spend their time reading a 450-page book covering topics like the different methods of individual stock analysis, unless of course they have a genuine interest in the topic. And on the other hand, the amount of time spent on strategies that are highly unlikely to outperform an index makes the book an unnecessary read for the aspiring investor. So A Random Walk Down Wall Street is one that I'd recommend most people to skip. My next non-recommendation is the 1994 release of Stocks for the Long Run by Jeremy J. Siegel. Much like Malkiel's A Random Walk Down Wall Street, Stocks for the Long Run hits on many of the same positive notes. It highlights different investment strategies and their shortcomings, it has data-driven commentary on investment principles, and it has interesting historical insights. But unlike A Random Walk, this one is a quick read and I found it to be well paced the whole way through. Unfortunately, this one also has similar shortcomings that stem from academically taught investment strategies that have not been shown to outperform the market. The goal with this book is again centered around minimizing risk through the use of extensive diversification, with virtually all attention directed towards the quantitative, easily measurable aspects of a business. Meanwhile, the implied conclusion that over long holding periods of 20 to 30 years, stocks are the safest investments stems from a faulty premise. Now, this conclusion is data-driven, since historically the American market has never underperformed bonds or treasuries over any 30-year time period after 1870. Even going back to 1802, over 99% of the time, stocks outperformed bonds, and over 96% of the time, stocks outperformed treasury bills. Nevertheless, conclusive sentiment drawn from these figures in later versions of the book led Charlie Munger to lampoon Siegel's ideas about investing, labeling the professor as demented in the process. Now, I don't think that Jeremy Siegel is insane, I just think that these projections were made absent-minded of sample size limitations. After all, there have only been 6 30-year periods of data between when the book was written and 1802. And I think that if you asked Siegel, he would agree that these figures are the outcome of historical American economic prosperity, and that there would be a much greater chance than 0.62% of bonds outperforming stocks in a scenario wherein past economic prosperity is not repeated over the next 2 centuries. Those major issues aside, I do think that the book's teachings are a net good. For instance, the book provides many arguments that equip the reader with an easy-to-grasp understanding of the underlying principles being taught, and it also promotes investing in diversified index funds. Again though, this book comes across as conflicted in that it's a 300-plus page book that goes into great technical detail at times, then directs the reader towards passive index investing. So I'm left considering why I would ever tell a novice investor to spend their time and money on this book when the virtues of index investing and the risks of individual stock selection and other investing dangers could easily be summarized in 100 or so less pages. For those reasons, Stocks for the Long Run can safely be skipped, in my opinion. With that, let's move on to Mark Mahaney's Nothing But Net, which is a much more recently published book that gives an analyst's perspective on internet companies. Now, one of the aspects of Nothing But Net that I really enjoyed was the focus on both the quantitative and the qualitative aspects of businesses that are mostly all still relevant today. I found that the company-specific focus utilized in the book helped me to broaden my understanding of many of the businesses that were highlighted. I also found that there were some takeaways that would likely be useful to keep in mind when considering other businesses for investment, even those operating in different non-tech sectors. The reason that I do not recommend this book, however, is because of its over-reliance on hindsight interpretation to claim that events or fundamental metrics explain why different companies succeeded or failed. In the book, nearly all of these claims were made using only a few individual cases as proof of the theory working, and are in a practical sense completely untested. That said, Mahaney does acknowledge that his record of picking winners has been somewhat of a mixed bag, and while the winners have been very large, the losers tend to have a recurring theme, in that they're the result of following expectations based on a success trait that was recognized in a different company who previously succeeded. Unfortunately for some of these theories, the previous successes of identified winning traits must be walked back on a few occasions in the book, with Mahaney pointing out that there are additional nuances that make some of these traits unreliable as success indicators. Personally, I'm not entirely on board with the idea that these traits are what were actually behind the first successes, and I definitely do not agree with some of the other more radical ideas being used to value companies that haven't achieved profitability yet. Two examples off the top of my head are the notion that past performance can be used as an indicator of future performance in tech stocks, and that revenue growth is the best metric to apply when valuing these companies. Naturally, the hubris of these statements have collided with reality, and since publication, most of the lauded business examples were decimated once easy access to capital dried up on account of higher interest rates. But even with all of these negative elements, I did really enjoy reading this book, and I thought that there were some worthwhile insights into the tech sector and some specific tech companies. But because of the dangerous rhetoric, I can't possibly recommend Nothing But Net on my channel, since following the strategies outlined would likely yield a dangerous result. So this is another one that you can skip. Alright, now it's time to get into the books that I think every aspiring investor would benefit from reading. And like high quality bottles of alcohol, I keep high quality books on the top shelf, that way they're distinguished from everything else and quickly accessible should I ever need to go back and reference them. My first recommendation is one that I've already made here before on the channel, and it's William Thorndike's The Outsiders, 8 Unconventional CEOs and Their Radically Rational Blueprint for Success. Thorndike's book sets out to track 8 different CEOs who led their respective companies' stocks to statistically significant outperformance against the broader market and their direct industry peers. In an attempt to break down the processes that create such unusually excellent returns, this book takes a look at the common attributes shared between this overachieving group, and it exposes some big differences between their methods and the norms of most other companies. Personally, this book had a hugely positive impact in bolstering my framework of what to look for in a good CEO, and more importantly, it helped me to realize some serious red flags pertaining to corporate bloat, capital allocation, and incentivization. Noting that, I think that this book fails at its central premise. If you take a look at all of the CEOs and the uncommon principles that they tended to employ, you'll notice that for about half of these shared traits, there are exceptions to the rule. Also, it's hard to ignore that the model used in coming up with the list of superstar CEOs is one that contains a fair amount of hindsight bias, since it would have eliminated outsiders who utilized the same strategies, but who did not achieve outperformance. Despite these huge flaws, I'd still recommend this book for its great lessons on capital allocation and business management. And while you probably won't be able to use this book to pick out the next superstar, it will definitely give you a better perspective on a CEO's duty, and it will challenge most people's perceptions of good business management. After all, unlike the books that I did not recommend, The Outsiders is mostly informative rather than prescriptive, let alone harmful. Plus, the uncommon traits among the studied CEOs, in my opinion, seems to be indicative of at least a non-random correlation, meaning that there is probably some truth to at least some of the outlined traits, even if they aren't perfect predictors of future performance. Also, I have to mention that the recurring pattern of going through the different business leaders, their biographies, and their practices one after another would normally lend itself to being a boring and repetitive read. But The Outsiders never came off as boring or slow, which is definitely to the reader's benefit, because going through each of these cases one by one really helps to instill the similarities being examined. For these reasons, I think that anyone who is interested in becoming a better investor would greatly benefit from reading this book, even if it's just to get a better understanding of a select few outliers and their success stories. So, as long as you go into this book aware of its shortcomings, I think you're going to come away from it with a lot of valuable lessons that will improve your ability to understand management's role in a business. So, William Thorndike's The Outsiders is a book that should be on your reading list if you haven't read it already. Next up is Thinking Fast and Slow by Daniel Kahneman, which isn't so much a business book, rather it's a psychology book that aims to break down how rational minds can make irrational decisions. This book is basically a summary of Kahneman's life work, devising studies and research into why people make the decisions that they do, and the biases that influence their decisions. Now, this pick might not seem like it belongs on a list of finance and business books, but there are several research cases in Thinking Fast and Slow that are centered around the field of investing, business, and economics. But more importantly, the lessons learned in this book are highly applicable to a number of different fields and everyday life scenarios. The way that Kahneman breaks down the functioning aspects of the mind into two distinct systems that operate very differently is seamlessly worked into the book in a way that makes it perfectly understandable why normal, rational people can make objectively bad choices, and how these misunderstandings and biases can continue to exist around us, largely unnoticed. Personally, after reading this book, I found that I was much more capable of recognizing faulty rationale in both myself and others, and I was able to implement several useful changes to my own thought processes, which should allow me to come away with better outcomes from intuitively made decisions. Unfortunately, there are a few minor critiques that I must apply to this otherwise excellent book. Firstly, I felt that the writing style at times left me feeling a bit confused about what I had just read, so much so that every couple of chapters, I'd find myself going back a paragraph or two to try and figure out what exactly Kahneman was trying to get across. Plus, it didn't help that there were, on a couple of occasions, the odd grammatical error that changed the context of what was being described. Noting that, further paragraphs always contained examples that made everything that I was struggling to grasp much clearer. But still, the writing style did leave something to be desired. Also, I found that once I did achieve a good understanding of the material, some of the chapters had a tendency to feel a bit longer than they needed to be. So, I think that this book could probably benefit from having another editor comb through and tighten it up a bit. Those minor issues aside, the content within the book is really exceptional. Every chapter is jam-packed with incredible insights into the mind, and I think that this book is a must-read for practically everyone, especially investors, whether they're just starting out or highly experienced. So if you haven't already read Daniel Kahneman's Thinking Fast and Slow, I'd highly recommend it. And the final book that I read is Where Are the Customers' Yachts? Or A Good Hard Look at Wall Street by Fred Schwed. Where Are the Customers' Yachts is a book that offers a cynical look at the inner workings of Wall Street through the early 1900s before and after the Great Depression, but a lot of the commentary is relevant to the investment landscape of today. The book's snarky criticisms levied at the different types of investors, brokers, and bankers that can be found participating in the markets are very funny and reminiscent of many current investment styles and philosophies. What the book does really well is highlight some of the common pitfalls and dangers of risky strategies, ignorance, and mob mentality in a comically wise way. Plus, the entire book is a very quick read, coming in at only 165 pages with fairly large font and the odd full-page comic. I'm not a particularly fast reader, and this book took me less than a week to read from cover to cover, and I only tend to read this type of literature for about an hour or so per day. That said, this is also probably one of my biggest criticisms with the book, as it doesn't really offer a ton of additional useful information for more experienced investors that goes beyond just the investment philosophy regularly preached by Warren Buffett and the like. Also, I have to say that I did find some of the writing to be a bit dated for my liking, but that's probably to be expected when reading something from the World War II era. That said, a lot of the book's material is timelessly relevant and contains a lot of wisdom written in an easily digestible way for investors who aren't as familiar with the Buffett and Munger school of thinking. So, while I do think that there are probably some people who could skip this one, I definitely recommend it for novice-level investors, and I think that this would also be a worthwhile read for most intermediate-level investors. And because of the punchy writing style, I do think that there is some enjoyment to be had even for more experienced investors who might be curious about the book. So, Where Are the Customers' Yachts is a book that I would recommend reading for most investors, if only to get a quick rundown on the dangers of speculating. And those are all of my book recommendations. So let me know in the comments what your top book recommendations are, or if you've read any of the books that I just reviewed, then let me know what your opinions are on the review. Whether you agree with me or not, I always like to hear different perspectives. Regardless, hopefully this video was successful at improving your list of quality reading material, since I can't stress enough how important it is to make time for reading. Currently, I'm in the process of reading Devil Take the Hindmost, A History of Financial Speculation by Edward Chancellor. I'm only about 50 or so pages in, and already I've learned way more important, accurately sourced historical economic facts that have expanded my knowledge dramatically, and the book has exposed me to some historical inaccuracies that are commonly expressed throughout the investment world today. So, I hope you enjoyed my video, and hopefully you enjoy some good books. Thanks for watching all the way to the end, and enjoy the rest of your day.